This is my thesis right now. I believe they are going to intentionally destroy the dollar. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve, because you are seeing the governments that used to support our debt are no longer doing so. I think saving dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it.
You're watching Silver News Daily. Subscribe for more.
Silver price suppression is collapsing in real time, and almost no one is ready for what happens next. Behind the scenes, a quiet war is erupting across global markets, and silver is right at the center of it. Andy Schectman's latest warning isn't just dramatic. It's backed by hard data, shocking movements from foreign nations, and a monetary shift that's accelerating faster than most people realize. As China and Saudi Arabia aggressively drain Comex inventories, the London Bullion Market Association is trapped in a historic short squeeze. Physical silver is vanishing, premiums are spiking, and the paper games that held this market down for decades are unraveling at the seams. Meanwhile, the dollar is being intentionally devalued, the Fed is cornered, and the global currency reset isn't coming. It's already begun. What's the target? $3,000 silver may sound extreme, but when you strip away the manipulation and watch what's happening in the physical markets, that number stops sounding so crazy. And here's the truth. They don't want you to know any of this. The mainstream won't cover it, and the institutions are still pretending everything is fine, but the cracks are spreading, and if you're paying attention, this may be your last real chance to stack before silver enters a new era.
Oh, I'd like to maybe switch gears a little bit and move to precious metals, gold, silver, platinum, to talk about a few things that I saw. And you stop me at any point. We can talk about anything that we've talked about so far. Okay, so I've been thinking a lot about the gold to silver ratio, and you got Goldman Sachs and JP Morgan forecasting $4,000 gold by next year. I think that's pretty reasonable, actually, on many levels. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, where it's averaged about 45 to 1 for the last 150 years. At 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. And so when I think about where silver could ultimately go, there are so many things that are screaming silver and its value right now. UBS just raised its target to $42 an ounce. That's about an 11% increase. But when you look at all of the things that have been happening, to me, whether it be the increase in the lease rate, the lack of shares available to short or to buy to cover shorts on SLV, the massive delay from T+1 settlement in London to T+8 weeks in London, the huge deliveries. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce. That's a solid, 50% gain almost. So you're talking about, I think, the value of a generation. And it seems that things are changing. The way that the market is moving. We're not seeing these massive sell-offs. We're seeing consolidation, choppiness, volatility, but the strength is something that is very different than what we've witnessed before. I'm very, very, very hopeful for what the rest of the year brings for the price of silver. I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's trading billions in unallocated bullion contracts unbacked, selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. But again, UBS is saying 38 to 42 through September 2025, they're talking just in a month through June 2026. So they're basically saying we're right there. By the way, for the people who we're recording this on Monday, the options expire today. So I expect today to be volatile, just like Friday was and Thursday, but I expect it to shoot right back up tomorrow. We'll see if I'm right when the next contract hits the board.
For decades, silver has been quietly suppressed through a vast network of paper contracts, synthetic futures, and coordinated sell-offs. But that system is now under siege. What we're seeing today is nothing short of a breakdown in the suppression mechanism itself. Comex, the heart of the paper silver market, is bleeding physical ounces at an alarming rate. Just look at the lease rates. Silver borrowing costs, once near zero, have exploded to between 6 and 9%. That's not normal. It's a direct sign of panic in the physical markets. And it doesn't stop there. The paper-to-physical ratio on Comex has reached an extreme 378 to 1, meaning for every ounce of real silver, hundreds of claims exist. This is financial illusion at its finest, and the illusion is cracking. Every time silver tries to break through key levels, $28, $30, $32, you'll see a flood of contracts dumped between 8:30 and 11 a.m. Eastern. It's a pattern that's been identified and documented. But for the first time in years, those sell-offs are starting to lose their power. Physical demand is now strong enough to overpower the shorts. Settlement delays in London have gone from days to over a month. EFP premiums, normally flat, spiked to 80 cents in 48 hours. These are stress fractures in the system. JP Morgan's own withdrawal of over 645,000 ounces from Comex in one day is not the move of a bank confident in the paper system. It's the action of insiders positioning for what's coming. When the music stops and those 378 claims come calling for real metal, there won't be enough to go around. This is the beginning of the end for silver price suppression, and those watching closely know that what comes next could change the market forever.
Government does, but to print our way out of this problem, and then eventually reshore manufacturing to grow your way out over the thesis that we talked about. But it has never, ever, ever been more important because of decades of low interest rates and money printed and inflated printing and inflated asset prices. It's never been more important to understand where we are going. I think that, it's interesting. One last piece. You have the equities, U.S. equities now at over 50 trillion. You have gold at over 3,400. You have Bitcoin at 120,000. You got all this stuff, crypto market cap at 4 trillion. That the economy is stagnant with GDP barely up 1% on the year. So you have stock prices outpacing corporate profits, trading at 30 times earning. You have Bitcoin going to the moon, but it creates no output. It doesn't create a profit. It creates no output. It's just a higher price, right? So much of the market value we see in stocks and crypto and everything, I read an article by Bill Bonner. He calls it ghost wealth, where it's enormous on paper, but disconnected from real production or income, where you aren't creating anything for the income. It's ghost wealth, and that's dangerous. You talk about stable coins being backed by U.S. Treasuries, so you have a stable coin backed by debt? Doesn't sound too stable to me. Let's see. Annual buy now, pay later transaction volume is expected to reach a record 116.7 billion this year, double the 2022. Lending Tree survey showed that 25% of users now rely on buy now, pay later to buy groceries. I saw the article showed Adam Taggart had a piece up saying that it's being used to buy Chipotle burritos, up sharply from 14% last year, and 25% of buy now, pay later users missed at least one payment this year. Americans are piling on debt like never before. So that kind of covers everything that I found interesting over the last week. I'm sure there's a lot more, but you can sense this acceleration. I mean, things are starting to really move. And again, and I think now more than ever, people need to understand why we own gold. It is not to become wealthy. It is wealth. And it's going to back the new system. That I do believe. But being in dollars right now is really, for your financial health, the worst thing you can do. And we can see that on a myriad of metrics.
Silver isn't just money anymore. It's the backbone of the new industrial age. And demand is hitting levels the market was never built to handle. In 2024 alone, industrial consumption hit a record 680.5 million ounces. But 2025 is already on track to surpass that. Why? Because silver has quietly become indispensable to the technologies reshaping the world. Solar panels now account for nearly 20% of total silver demand, a fourfold increase from just a decade ago. And despite all the industry's efforts to thrift silver usage per panel, the scale of global solar expansion has completely overwhelmed any efficiency gains. But solar is just the beginning. Electric vehicles are rewriting the rules. A single battery electric vehicle uses up to 50 grams of silver, almost double what's needed in internal combustion engines. Multiply that by tens of millions of EVs rolling off production lines each year, and it's no surprise that automotive silver demand is closing in on 90 million ounces annually. And then there's the silent giant, artificial intelligence. AI servers consume 2 to 3 times more silver than traditional data centers, and due to increased energy throughput and cooling systems reliant on silver-based electronics. This isn't a passing trend. It's a total transformation of silver's role in the global economy. What once was seen as a speculative metal is now a critical input. And with supply growth unable to match demand, the imbalance is growing more dangerous by the month. Institutions are only just waking up to this, but the retail investor still sees silver through the old lens, as a sleepy cousin of gold. That's about to change. Silver's industrial utility has now created a price floor, one that's rising with every new EV, solar array, and AI server built. The longer investors ignore this shift, the more violently the market will reprice when reality hits.
They would have to have it pegged to something like gold and redeemable in gold, because the longer the duration, the higher the risk. And who the hell wants that? Especially from countries that are our competitors, our foes. They don't want to support the dollar anymore. And why would they? You can see the infrastructure with Brics Bridge and Brics Pay, etc. Let's go back to the metals. I found it really interesting. The head of the Japan Bullion Market Association, Bruce Ikemizu, Ikemizu, formerly head of the Chinese bank ICBC Tokyo Precious Metals Desk, and now head of the Japan Bullion Market Association. He came out and said the market may already be broken. And he says London appears to have virtually no physical platinum available for delivery. He says that he thinks that there's basically no platinum in London and Zurich, and yet they're still trading nearly 3 million ounces a day of London promissory note cash contracts for immediate platinum ownership and delivery. I mean, he says something's about to break. What could possibly go wrong if you're trading 3 million ounces a day of promissory notes to deliver? And he thinks they virtually have nothing. And he says that because there's a 30% interest charge to borrow platinum. It's ridiculous. It's never been that high. He says he cannot recall a time where lease rates were even close to that high, and have rose that sharply. But when you talk about the banks that who borrow, or the producers, like recyclers, like jewelry manufacturers, industrial users, they're behind the banks, that they're the actual users who borrow from them. So why would you pay 30% interest to borrow? Why not just go buy it flat out? And I think the frailty of the London platinum market it can very quickly just spill into the London silver market, which we've talked about, where you have lease rates at 7% for 1 month. I've never seen it that high in my career, ever. It's the same issue. They have no supply. Again, I think this is something to continue to watch. This is why I think things are changing in every way. And the rest of the world, they're wise to this. And they're kind of like the vulture circling the wounded animal. And then the wounded animal is the LBMA. A couple more things to talk about off topic. I found it interesting that Jeff Bezos has been on a selling spree since late June. He has sold $5.7 billion worth of Amazon stock. Now, if he thought that the stock market was going to go up and up and up, why would he sell $5.7 billion? This goes in line with all the other insider selling we've talked about ad nauseum. I also find it interesting talking about saving in dollars. You're destined to go broke. Well, part of what Trump wants is a weak dollar, right? If you revalue gold, by the way, what you do is you devalue the dollar. When Roosevelt increased the price of gold from 20 to 35, he did it by devaluing.
The supply side of silver isn't just under pressure. It's unraveling. For the 5th year in a row, the silver market is locked in a deep structural deficit. In 2024, the shortfall hit nearly 149 million ounces, and projections for 2025 are showing another 117.7 million ounce gap. That's not a one-off or a seasonal dip. This is a systemic collapse in supply, and it's being ignored by almost everyone. When you add up the deficits from 2021 to 2024, the market has burned through 678 million ounces of silver. That's equivalent to 10 months of global mine production, gone. Consumed, not coming back. Now here's the kicker. Global mine production only grew 0.9% in 2024, and in 2025, it's projected to contract again. We're not talking about marginal declines, we're talking about a 7.23% drop from 2016 levels. And this isn't due to lack of demand, it's the result of aging mines, declining ore grades, rising energy costs, and mounting regulatory pressure. Some of the world's biggest silver producers are now warning that new discoveries simply aren't coming fast enough to replace what's being extracted. Meanwhile, industrial demand continues to surge. That means the gap between what the world needs and what it can produce is widening. And unlike gold, which is mostly recycled and stored, over half of all silver is consumed permanently. Once it's used in electronics or solar panels, it's gone for good. The inventories that once plugged these deficits are drying up, and what remains is being drained by the smart money behind the scenes. Michael DiRienzo of the Silver Institute summed it up perfectly. The structural deficit in the silver market is unprecedented. That's not hyperbole, that's a warning. The market is sleepwalking into a crisis, and when the moment comes where investors realize there isn't enough silver to meet both industrial and monetary demand, the repricing won't be gradual. It'll be explosive.
Yeah, well, and they have the state-sponsored accumulation programs for Chinese housewives. I mean, they're pushing their populace into owning gold. You can see this is a bigger deal than just the state owning it. They see a benefit in their public, in their constituents across all of China to own gold. And in all of the provinces, it's not just in Shanghai, it's a big deal. An interview that I watched last night blew my mind. And it supports a lot of what I've been saying. It's with the Brics Pay CEO. His name is Andre Mikhailishin. I'm butchering that for sure, but he's the Brics Pay CEO, chairman and founder, Andre Mikhailishin. Anyways, sorry, Andre, for butchering your name. I'm sure I did, but some things that he talked about Brics Pay. Now, first of all, one of the questions that was asked of him, and we fortunately got this right, was what's the difference between Brics Pay and Brics Bridge? He said Brics Bridge is basically mBridge, and it is a technology that is fully backed, as we know, by China, Hong Kong, Thailand, UAE, and Saudi Arabia. They're the five main participants in the Brics Bridge technology, formerly mBridge, and it is, as he said, a cross-border CBDC platform for central banks from Saudi Arabia to China or whatnot. And now, one of the big things that we talked about last time I was on your show was the expansion, according to Sergey Lavrov, of the Brics Bridge platform into non-Brics countries. I mentioned the Belt Road specifically, 150 plus countries, 75% of human population, north of 50% of global GDP. They were going to use Brics Bridge for these central banks to trade with one another. Think of the new Shanghai Gold program. So they will trade with one another across the bridge, free from SWIFT interference, in local currencies, and then settle imbalances in gold. We were spot on that. Very early to say that, spot on, and that's just the beginning. Well, he also talked about Brics Pay. Brics Pay is a technology that is B2B, business to business. It is consumer to business, business to consumer. It is bank to bank. It is one notch below the Brics Bridge program. It is also free from SWIFT interference. They talked about having aspirations of at some point of being integrated with things like Visa and MasterCard, but they're not because of the sanctions that are put on Russia and Iran. And this is primarily being driven by the Russians right now, the Brics Pay.
Comex is no longer the fortress it once was. It's bleeding silver, and the predators are circling. China and Saudi Arabia aren't just watching this unfold, they're orchestrating the depletion. These two global powers have turned their attention to silver, and they're draining the West's inventories with calculated precision. As of early 2025, Comex had just 87.5 million ounces of registered silver left. That's the deliverable supply, and it's now at multi-year lows. Eligible stocks aren't much better, standing at 271.8 million ounces. Put together, it's a shadow of what it once was, and it's vanishing fast. On July 11th alone, over 600,000 ounces were withdrawn in a single day, and JP Morgan led the charge with a pull of 645,497 ounces. These aren't flukes. They're part of a persistent pattern of outflows that's been quietly accelerating. The East understands what's coming, and they're positioning accordingly. And here's what makes this even more serious. The total Comex inventory, even at 359 million ounces, covers less than 5 months of global industrial demand. That's not a buffer. That's a ticking time bomb. But why are China and Saudi Arabia so aggressive? Because they see the writing on the wall. As the global monetary system shifts and faith in Western paper assets collapses, physical metal is becoming the new foundation of trust. These nations are stacking silver not just as a hedge, but as a weapon. Every ounce pulled from Comex weakens the Western financial structure and strengthens their own reserves. This isn't just a market shift, it's a geopolitical maneuver. The result? A looming delivery crisis. With more investors demanding physical and fewer ounces available to meet those demands, premiums are spiking and delays are becoming the norm. The West is being cornered by its own complacency, and the East is seizing the moment. The Comex vaults are being emptied, and when the metal runs out, so does the illusion of control.
Organization, the Eurasian Economic Union, the Brics, and all of the other countries, like the countries in Southeast Asia, the Eurasian countries or the Asian countries rather, that have just signed up to Brics Bridge, they in and of themselves, with the 5 Middle Eastern countries that did represent 38% of global GDP. Now you open all of this up to non-Brics countries, bang. Well, now they're opening Brics pay to non-Brics countries, right? So he said something really blew my mind, and I've never heard this before. Now, granted, the reason I left my corporate office in Minnesota is because it's the only state in America, and again, they're now re-implementing it, licensing and bonding. And so we're very attuned to anti-money laundering laws and know your client legislation. They said, well, how you know you're not funding terrorism? And he said, well, because we're opening this up to other countries, we are keenly aware of compliance issues in all of these countries. And he said, our software is compliant with AML, anti-money laundering laws, and KYC. Now, you know that, right? You know what KYT is?
I do not.
Neither do I, until I Googled it and figured it out. Well, I listened to what he said. I rewinded it again. He said, our software is compliant with KYC, AML, and KYT. Now, before I tell you what KYT is, I want you all to think about this in terms of stablecoins and this digital surveillance world we've been warning you about. That a lot of people say that these stablecoins are kind of like a CBDC in sheep's clothing, kind of like it still gives the central authorities the ability to monitor, to track the on-ramp and the off-ramp, do all these things. Well, guess what KYT stands for? Know your transactions. So their software is compliant with know your customer, anti-money laundering, and know your transactions. So guess what? What you are buying ultimately is going to be part of this software. You go and buy a couple AR-15s for your home protection, may not be a good idea. You go buy bullets, you go buy alcohol, you go buy cigarette, whatever it is that you're going to buy, guess what? It's going to be known. And that's part of this whole new digital ecosystem. And I think it's kind of scary if you ask me, but I had never heard that before, as you and I are pretty well in tune to this kind of stuff. I don't know if you have any thoughts on that, but I thought it was kind of...
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. The Federal Reserve may have thought it had more time, but the walls are closing in, and its next move could ignite silver like never before. Just months ago, the idea of a rate cut was met with skepticism. Today, markets are pricing in a 94% chance of a cut by September. Why the sudden shift? Because the data is unraveling. Employment growth has fallen below 100,000 per month, and prior figures are being quietly revised downward. Meanwhile, debt servicing costs have exploded, rising from 8% to 18% of tax revenue in just 3 years. That's not sustainable, and the Fed knows it. But here's where silver comes into play. Precious metals have always moved ahead of the Fed, not after. When traders sniff out the pivot, they don't wait. They buy. And right now, they're buying. Silver is already up nearly 30% this year, and it's outperforming gold for the first time in a decade. The reason is simple. Silver doesn't yield, and when the cost of capital collapses, that disadvantage disappears. Suddenly, silver becomes not just a hedge, but a magnet for capital fleeing deteriorating bonds and overvalued tech. What's more alarming is the internal dissent within the Fed. For the first time in decades, FOMC members are publicly disagreeing on policy. That kind of division is rare, and historically, it's marked moments of extreme volatility. When central banks lose consensus, markets lose confidence. And when confidence in fiat breaks down, hard assets turn. The connection is undeniable. Every time the Fed blinks, silver responds. In 2008 and 2011, and now again in 2025, the pattern repeats. The only difference this time is scale. The debt is larger, the deficits are wider, the margin for error is gone. The Fed is trapped, and every move it makes from here could add more fuel to the fire already burning under silver.
Wonder, is it a conspiracy or is it reality when you talk about when Chris Powell says there are no free markets, just manipulations? The traders suck in the speculators, and then right at the end, they smash the price so that the options expire worthless. The big banks get to keep the premium on that, and then it goes right back up. They rinse, wash, and repeat. But this is a game that's much more difficult to do so. And it kind of reeks like we're getting to the end of this game. We've heard that before, but the level of the spread in the exchange for physical jumping up 250% last week, the no shares available to borrow of SLV, none when there's usually millions. The 7 or 8% lease rate, highest I've ever seen. The T plus 8 weeks, the deliveries. Things are changing, and it's as dumb as a mud wall to continue this game. I think they know that. I also want to talk about perception. You know, I wrote down homes are getting cheaper in gold. Now, homes aren't getting cheaper, but they are in gold. And, you know, people talk about this real estate deal where homes are so unaffordable. They're not unaffordable in gold if you've been holding gold, because measured in dollars, you're getting crushed. Measured in gold, you're winning. Since 2005, it's fallen off a chart. It's gone straight down. The amount of gold that you need to buy a home, it's at almost all-time lows or very darn close to it. So in other words, gold is keeping pace. The dollar is not. This is the point that needs to be understood, is that gold is not here to make you wealthy. It is wealth that keeps pace with inflation. And that's
The dollar is crumbling, and silver is feasting on the fallout. In 2025 alone, the US dollar index has plunged 11%, and that drop isn't random. It's the result of intentional monetary engineering designed to extend a broken system just a little longer. But every intervention has consequences, and this time the consequence is a flight from fiat into tangible assets. Silver, with its unique dual role as both monetary and industrial metal, is leading that exodus. At the center of this shift is the Genius Act, a bill that on the surface looks like stablecoin regulation, but beneath it creates synthetic demand for short-term treasuries. Why does that matter? Because it pushes the entire monetary system further into short-duration debt, concentrating risk and accelerating dollar velocity. The Treasury is essentially cannibalizing its own system to fund itself, and in doing so, it's undermining global confidence in the dollar. Foreign central banks are reacting. China has doubled its gold and silver reserves. Poland, India, even Egypt are joining the wave. Why? Because when the world's reserve currency starts behaving like an emerging market asset, capital moves to safety, And safety today isn't dollars, it's metal. Silver's 29.5% year-to-date gain isn't just a rally, it's a vote of no confidence in fiat. And the impact is cascading. Investors are watching the purchasing power of their dollars erode and are waking up to the reality that inflation is no longer transitory. It's embedded. And in a world where governments are openly discussing debt monetization, silver is emerging as one of the last lifeboats in a storm of paper. The more the dollar falls, the more silver rises, not just in price, but in strategic importance. The currency reset is happening in real time, and silver is the reset.
Valuing the dollar by 40%. He wants a weak dollar to make manufacturing more competitive. So part of bringing back the manufacturing and reshoring it, you have to have a weak dollar. Look what the dollar's done. It's fallen 11% this year. And so he wants a weak dollar. He wants low interest rates so that he can, and then ultimately, you have the stable coins front loading the short end of the market to facilitate debt. But then you peg gold to the back end to have zero borrowing costs to bring back your manufacturing with a weak dollar. He said yesterday or the day before that he likes a strong dollar, but you make a hell of a lot more money with a weaker one. He says, so when you have a strong dollar, one thing happens. It sounds good, but you don't have tourism. You can't sell tractors. You can't sell trucks. You can't sell anything. So he went on to say that manufacturers, would be the first to benefit from a falling dollar. Japan and China fought for weaker currencies for decades and were able to dominate markets over the years. Now it doesn't sound good, but you make a hell of a lot more money with a weaker dollar. These are the crumbs that I speak of that I've been following for 5 years. You find crumbs and either you take it for what it is and realize that these people who talk, part of their conscience comes out when they speak. They may not be fully honest, but they're telling you what they want. They want a weak dollar. He knows a weak dollar is a necessity, and that's where we're going. And the funny thing is that, look, as he goes on, as recently as 1999, the U.S. had a budget surplus and a debt of $5.6 trillion. We were widely admired, and the federal debt was bought as a monetary reserve all over the world. It isn't anymore, and this is a problem, having a weaker dollar and lowering interest rates. So, one of the things that I found very interesting, this last article I read, was how home affordability is so high, and that lower interest rates would help, and would help first-time house buyers, as an example, with cheaper money. But think about this. We're so far down the rabbit hole. This is why things have to change. If we lower rates just to allow the anomaly to continue and for prices to continue to rise, how does that help a first-time home buyer? Lower interest rates, because of the printing and the buying of bonds, would cause all other prices, like food, fuel, insurance, taxes, upkeep, everything, to rise, just like it's done in this low interest rate environment over the last decade, where asset prices have gone parabolic. And so, if they do lower rates, and all the talking heads will say what a great job they did by lowering rates, it's just going to spike inflation again. So the moral of the story is that the dollar is going to weaken further. You're going to see a weak dollar. You're going to see a situation where the Fed has no choice.
The gold-silver ratio is screaming one message louder than anything else. Silver is wildly undervalued, and that imbalance is about to correct with force. Right now, the ratio sits between 88 and 91 to 1. That means it takes nearly 90 ounces of silver to equal the value of just 1 ounce of gold. Historically, this ratio has averaged closer to 45 to 1 over the last 150 years. But when the financial system is stressed like it is today, this gap doesn't just close. It snaps back violently. Think about this. If gold were to hit $4,000 per ounce, which many analysts now believe is not only possible but likely, a 50 to 1 ratio implies an $80 silver. And that's just using conservative math. Some experts, like Andrew Maguire, argue that the true natural ratio should be closer to 10 to 1, based on the metal's geological scarcity. That would imply silver should already be in the hundreds. Even if we never reach that extreme, the path toward a 35 or 45 to 1 ratio alone could double or triple silver's current price. And we're already seeing the first signs of this compression. The The ratio peaked above 100 earlier this year but is now drifting lower, a clear signal that silver is entering a phase of outperformance. Technical traders are watching this closely, and once the ratio drops below key thresholds like 80 and 70, it tends to accelerate downward. This isn't theory. It's history repeating itself. Every major silver bull market has been preceded by an overextended gold-silver ratio. Every single time. And each time, silver has not only caught up, it's exploded past expectations. Right now, that rubber band is stretched tighter than ever before. And when it snaps, it won't just close the gap. It'll leave gold in the dust.
Expand on that, Dunnigan, and because this is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue, because you are seeing the governments that used to support our debt are no longer doing so. Right? You have now the Cayman Islands and the United Kingdom and Ireland. It's a joke. And they understand that the amount of debt, we have to come up with $28 trillion in debt in 3 years when we only take in $15 trillion in tax revenue. We're not there. They understand that. And we're seeing less and less and less buying of our treasuries. So instead, they passed the stablecoin law where all of these stablecoins will be backed by US dollars in order to have demand for a treasury market that is losing demand. So you put that all on the short end of the curve, right? Where I think they're going to do it, and kind of blur the significance of the long end, which I'll get to in a moment. But I think that's first and foremost what they're trying to do. Remember when Janet Yellen did that, that was good for gold, that was good for stocks, it was inflationary. And I think that's what they're going to try to do. At the same time, they reshore all the gold and they're going to let it go higher and higher and higher and higher. Not very easy for the public to discern. There'll be volatility, there'll be consolidation, but it will keep going higher until people feel it's gotten too high. And then they'll probably come in and revalue it to a level much higher. And they're going to peg it to the treasury. Why would they do that? Why would they peg gold to the back end of the treasury market? The short end, the front end, will be backed by these stable coins, which they will pump out by the gazillions, because now they have this synthetic demand, not a organic demand like we used to have when we were revered and we ran a surplus and we didn't instigate wars all over the world and fund wars all over the world, and we're not revered anymore. So the back end of the market, who hell wants, and especially when Trump talks about creating all of this money to rebuild our infrastructure. So in essence, printing money to build our infrastructure to compete with the rest of the world. They don't want to buy our treasuries. So they will just do the stable coins to get all of this demand for the front end and load the debt there. But the back end, I believe they will peg to gold. As Judy Shelton has said, on July 4th, next year, the 250th anniversary, he has said it repeatedly. Again, she keeps saying it on Twitter. He will peg the 50-year treasury to gold. Why would you do that? And you have to get gold much higher. And I think she keeps talking about gold revaluation. They will revalue gold. And I think Luke Groman, one of the smartest dudes I've ever met, he's talking about revaluing gold. He thinks they'll let it go to 7, 8, 10,000.
Behind the scenes of the global financial system, a new architecture is being built, and silver is about to benefit in ways few truly understand. The Brics nations, Brazil, Russia, India, China, and South Africa, are not just talking about de-dollarization anymore. They're doing it. And their blueprint is shaking the foundation of Western financial control. These countries, along with dozens of allies through the Belt and Road Initiative, are developing parallel payment systems that bypass SWIFT, benchmark currencies to gold, and prioritize physical assets over paper claims. China's CIPS system now processes more transactions than SWIFT itself, and the Shanghai Gold Exchange is pioneering immediate physical settlement, T+0, while Western markets still delay. This shift is not just technological. It's philosophical. Brics is rejecting the fiat-based, debt-driven model of the West and anchoring their systems in commodities. And that's where silver comes in. If gold is the monetary anchor for Brics, silver is the bridge. It's the industrial workhorse that supports the infrastructure of the new system: solar power, electronics, digital payments, and energy grids. Brics collectively controls around 85% of the $8 trillion global commodity complex, giving them the power to rewrite how assets are priced. If these nations begin demanding settlement in gold, and soon silver, it will crush the leverage embedded in the paper markets. This isn't just theoretical. The expansion of Brics pay to non-member states means more than half the global population could soon be transacting outside the dollar system. As trust erodes in fiat currencies, physical assets become the new standard, and silver's utility makes it more than just a hedge. It becomes a tool of sovereignty. The more the Brics framework expands, the less relevance Western financial control holds, and the more explosive silver's upside becomes.
Dollars and then revalue it to a much higher level to give the Treasury General account $5-6 trillion in free, clear revenue without selling an ounce of gold. And we talked about how that happens. There's miscommunication on that too, because some people think that when the Treasury issues Treasury certificate or gold certificates, gives them to the Fed creates the money, takes the gold, and gives the Treasury money free and clear. Every $4,000 increase is $1 trillion free and clear to the TGA account. The Fed doesn't have control of that gold. They have control of the fiat. They're owed the money value of that gold, not the gold itself. Anyways, if they do that and peg it to the long end of the bond market, she said 50 years first, shorter durations, maybe 30 and 20, later, maybe 10. But why would you do that? Because now you can have zero borrowing costs. You can put a zero coupon on that. The gold redemption at the end is the borrowing, is the interest rate, is the inflation gauge. The more foolish we are in monetary policy, the higher the price of gold goes. To be able to get that at redemption would allow for long end low borrowing costs, almost down to nothing, which would then enable us to slowly reshore our manufacturing at very low borrowing costs, and then to grow our way out of this problem eventually. The only way you get rid of inflation and where we are right now is to produce our way out of it. And we're a long ways away from that, because in order to facilitate the amount of debt that we owe, pay it off, just the $28 trillion in maturing Treasury debt by 2028 with $15 trillion in revenue, we're halfway there. And that doesn't take into account the $3 trillion a year in deficit spending. So you're 25% of the way there. So you have to inflate. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market. And then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs, to reshore manufacturing, to sell Treasury debt, bonds at a much longer duration at a zero borrowing costs, redeemable in gold. I think they're going to do this. I truly do. And I guess we'll see. But I think to save in dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period. So that is my thesis right now. And I'm very, very convinced that this is something that they are, if not implementing right now, it is, by all of the things that we hear and see. It'd be too long for me to go through the whole litany of them, but I think that's where we're going.
If you want to see the future of silver, just look at platinum and prepare for deja vu. Right now, the platinum market is in full-blown crisis. Physical supply has evaporated. London and Zurich, once the centers of global precious metals trade, reportedly have virtually no physical platinum available for delivery. Meanwhile, the paper market continues to trade 3 million ounces daily as if nothing's wrong. Sound familiar? This is exactly what's unfolding in silver, just with a few months' delay. Platinum lease rates have exploded to an eye-watering 30 to 40% annualized, the highest levels ever recorded. That's not a technical glitch, that's a siren. It signals total dislocation between paper and physical pricing. And this isn't isolated. China imported a record 36 tons of platinum in Q2 2025, while over 500,000 ounces were rerouted into U.S. warehouses to front-run potential tariffs. This is capital flight out of paper and into metal, pure and simple. Silver is now on the same trajectory. Lease rates are rising, settlement times are dragging, physical is being hoarded, and just like in platinum, the Comex and LBMA are still pretending it's business as usual, but they won't be able to fake it much longer. As platinum proved, once physical constraints take over, the price action becomes uncontrollable. Traders panic, delivery fails, and premiums explode. The warning couldn't be clearer. Platinum's breakdown is the dress rehearsal. Silver is the main event. And if silver follows the same path, we won't be talking about what are $35 or $5 targets. We'll be staring down the kind of parabolic move that breaks algorithms, margin accounts, and market narratives in one shot. The paper game is ending, and platinum just showed us what that end looks like.
Thank you. It is. It's important for everyone to unplug however they do so. And kind of hard for me, but this was great. I laid on a chair over the ocean, basically, and read and have tried to keep up with the ever-changing pace at which things seem to be moving, so we can jump right in. And then I have, I write them down when I find something that it sticks out to me. So some of it will not really be in any particular order, but I try and look at stuff with the Brics, with the dollar, with interest rates, with everything that follows this narrative, and then some. And I found some really interesting things to chat about. So why don't we jump right in? We had talked before about the Shanghai Gold Exchange and the progress that they've made in both Saudi Arabia and in Hong Kong in this new vaulting structure. So I want to talk a little bit about that because there has been something in the way of updates. We went back to the beginning of May and we talked about the Saudis had opened up an account at the Shanghai Gold Exchange. And in fact, it had been officially launched. And what it was realizing was a two-way free exchange between renminbi and gold. And at the same time, it's facilitating Middle East investors to directly participate in the Shanghai Gold transactions through the Saudi Treasury. So on June 26th, the Shanghai Gold Exchange opened its international board, a designated warehouse in Hong Kong, and it launched these contracts. We talked about that. What I did just realize is that on the first day, many Chinese and foreign institutions successfully.
The cracks in the system aren't isolated anymore. They're compounding, and institutional players are beginning to lose control. Paper markets that once dictated price are now bending under the weight of physical demand. On Comex, settlement delays are becoming routine. Premiums are spiking, and traders are waking up to a terrifying realization. The metal they thought they owned may not actually exist. Silver's lease rates, historically near zero, have surged to between 6% and 9%. That alone would have been a red flag. But combine that with the 378-to-1 paper-to-physical ratio and London settlement delays stretching from days to up to 2 months, and you have a market on the edge of a breakdown. This isn't just tightness, this is dysfunction. The system can't deliver. The so-called hedging that banks and funds use has become a house of cards. The moment physical buyers step in and demand delivery, the entire chain of leverage is exposed. And we're already seeing it. Exchange for physical, EFP premiums, shot from $0 to $80 in just 48 hours, a move that screams stress and desperation. Major institutions that once controlled the narrative are now scrambling to plug holes in a ship that's taking on water fast. And here's the danger. The more this unravels, the more physical silver disappears into strong hands. Nations, central banks, long-term investors. Once it's gone, it's gone. The paper contracts left behind won't matter. They'll just be claims to vapor. This is what happens when confidence collapses. The market stops functioning as a price discovery mechanism and becomes a scramble for the last real ounces. The old system is failing in real time, and the institutions that built it are now watching helplessly as their control slips away.
Reach transaction. And so this is now in motion. We are seeing countries trading their renminbi, their yuan, directly into the Shanghai Gold Exchange, which is China's official platform for gold trading, by the way. And they're doing it directly without needing, the key to it is that they're doing it directly without needing intermediaries or converting through other currencies like the US dollar. So for investors, this provides opportunities and more efficient access to the gold market. And for Saudi Arabia and China, it puts them closer together. It slices apart, the petrodollar. It gives other options to settle in yuan or renminbi and then immediately convert it into gold. These are the little pieces, the little by little, the chess pieces that are being put into place that are very, very difficult once fully in place to disrupt. And there'll be more about this in a moment when I get into the Brics pay. But suffice it to say, this is a big deal. It is now operational. Gold is being delivered in the warehouse in Hong Kong. And the next one that is being built right now is in Saudi Arabia. Saudi Arabia is already set up in Hong Kong. And through the treasury in Saudi Arabia, other Middle Eastern nations will be able to participate. I was watching Andrew Maguire the other day. I love Andrew Maguire. I don't know if you've had him on your show, but he's one of my favorites. And through his sources, whoever they are, he said that the Chinese insurance companies in June raised the amount that insurance companies can invest into gold from 1% to 2%. That's 25% of global mine supply, if that's the case. And he's saying that a possible increase to 10% in 2026, you're talking all of global mine supply, just from a 10% toe in the water by Chinese insurance.
For years, silver bulls were mocked for claiming triple-digit targets. But now those forecasts don't sound so crazy. They sound inevitable. In 2025 alone, silver has already surged nearly 30%, and we're still only in August. The floor has moved, and the ceiling, that's being recalculated daily. Major banks like UBS have revised their targets to $42 by September. Saxo Bank is calling for $40. Investing Haven sees a peak of $50, while others are floating numbers as high as $88 before 2028. And then there's the outlier, a whisper of a $1,000 silver price. Impossible? Maybe. But in a world where $100 oil became $0 overnight in 2020, where banks collapse in 48 hours, and where central banks print trillions on command, nothing should be dismissed outright. But let's stay grounded for a moment. Even hitting $50, a level silver has only touched twice in history, would represent a seismic shift in wealth. It would break through decades of resistance, crush institutional shorts, and unleash a wave of FOMO buying not seen since the Hunt brothers tried to corner the market. At that point, silver wouldn't just be rising, it would be in full-blown escape velocity. What's critical to understand is that the fundamentals now support it. This isn't a speculative pump. It's the result of 5 consecutive supply deficits, record industrial demand, and a geopolitical storm that's pushing nations toward hard assets. Unlike past runs, this one isn't fueled by hype. It's fueled by scarcity. The window to accumulate silver below $40 may be closing fast. And once it slams shut, those watching from the sidelines will be forced to chase a market that no longer waits for anyone. Silver's breakout is no longer a prediction. It's a process already in motion.
Pay platform, so they are completely autonomous from the West. But he did say that in the future he sees Brics Pay and Brics Bridge being combined, so that you have the central bank portion, you have the B2B portion, all under one kind of big package of breaking free from the West. He said currently their representatives are in China to develop brick pay technology throughout the Belt Road. How do you like that? So the Belt Road is being already integrated. We know this through the Brics Bridge. And now they're going to open up Brics Pay on the Belt Road. So not only will the countries trade with one another as China industrializes them, as they pull the natural resources out of the ground, as they build the infrastructure to industrialize these third world countries in Africa and Asia and South America, they will do so free from SWIFT interference over the Brics Bridge and settle imbalances in gold through the Shanghai Gold Exchange and all the other exchanges like the one in Singapore and Moscow, the Brics Exchange. All of these other exchanges will be integrated into this system. But now they have their representatives negotiating in China right now to use Brics Pay amongst the Belt Road. This is massive, right? So you get all of these business to business, bank to bank, like commercial banks, regional banks, not the big central banks. That's the bridge. But Brics Pay will be bank to bank, business to business, business to consumer, etc., integrated through the Belt Road. That is a massive, massive, massive development. And I think it's something that should not be overlooked. He said something, Dunnigan, that kind of was one of these bang moments. And I'm like, holy crap, what did he just say? And I had to stop and rewind it, because I bet you no one has heard this before, but I want you all to think about this in terms of stablecoin and in terms of the digital world we are moving into. He said, and I quote, well, I don't quote, I'm paraphrasing, but pretty close to a quote. He says, They asked him, the gal asked him, she said, there's a lot of terrorism out there and bad people, and how you're not going to be financing terrorism or bad people, more or less. And he said, this is open, guess what he said, to non-Brics countries as well. Brics pay. Not compatible in the West yet, just like Brics Bridge, but it's open to non-Brics members. So you're talking expansion, massive expansion. This is what the Brics naysayers never caught on to. They didn't catch on to it yet with the Brics Bridge. We did, and we said by Lavrov opening it up to the non-Brics countries, you have just ignited a fuse under the dollar. Because now it's not just the 10 Brics countries. You're talking the majority of human population when you throw in the Belt Road, the Shanghai Cooperation.
Silver price suppression is unraveling. The global currency reset is no longer theory, it's reality. And this may be the last window before the floodgates blow wide open. The signs are everywhere. Collapsing Comex inventories, 5 straight years of supply deficits, lease rates going vertical, and industrial demand that's running hotter than anything we've seen in history. Brics is rewriting the rules. Western institutions are scrambling to hold together a paper market that no longer functions, and central banks are quietly stacking real assets while the headlines distract the public. This isn't just a silver story. It's a systemic shift. The fiat era is fraying at the edges, and silver is emerging as both the monetary truth and the industrial backbone of the new world order. The days of plus $50 silver are gone. The days of $50 silver are fast approaching. And beyond that, the ceiling isn't defined by charts. It's defined by how far this system can break before it resets completely. If you see the signals, don't wait for permission. Don't wait for the headlines to confirm what you already know. History won't look kindly on hesitation. The silver train is leaving the station, and when it runs fast. Make sure you're subscribed so you don't miss what's coming next. And remember, this is not financial advice. Always speak to a qualified professional before making any financial decisions.